And we're recording. Today I am joined by Ceri Evans from the Total Mortgage Network. He's a mortgage advisor that I've worked with in the past. And with COVID and the lockdown, the property market has been affected quite substantially. So we're going to talk today about the mortgage market, the property market, what effects have been, how the government loans and the support options will affect mortgage applications, and where we see things going in the future. So, Ceri, if you introduce yourself.
Morning, Jane. My name is Ceri Evans. I'm a mortgage and protection advisor. I've been in the industry about 7 years, and hopefully I can provide some insight into where we are currently and potentially where I see things going in the future, and give people a little bit of hope, really, for what mortgages and protection can offer them in the future.
Yeah, absolutely. And first of all, then, just a bit of background about you and how did you get into the mortgage game?
I think it's quite an interesting story. I don't know if everyone will agree, but I worked with Tesco in a low-level management role for a few years. Realised quite late on in that, probably about 10 years in, that it simply wasn't for me. Working very late evenings, working weekends, taking time away from a young family as well. Didn't work out for me. Decided very quickly to leave there and move into a sales role with Craft, we're now Mondelez. Worked for them for a few years. Didn't do very well at that, if I'm honest, when I look back at it now and think about it. Moved from there to being self-employed and selling chocolate and sweets into small and medium businesses. So just a transition really to self-employment, and that started my journey of self-employment. From there, my wife one day saw an advert in the paper for a mortgage advisor. She knew I liked numbers and finance and that sort of stuff. And she showed it to me, and I said, "Oh, it's out of date. There's no point in applying." And she did sort of encourage me to send a CV off, and I did. And just had a phone call, went down for an interview with the guys at Total Mortgage Network, and literally 3 weeks later, I was sat there training for CMA, getting ready to be a mortgage advisor, and that was 7 years ago. And I guess the rest is history. Really, I've loved every single minute of it in that respect. Really enjoy the job. Don't get me wrong, it can be difficult and stressful and all those things that come along with, just the nature of being self-employed in general. But it's a really good, fulfilling job, and one that keeps you on my toes as well. And something that when I look back, is quite fortunate that it happened the way that it did, to be perfectly honest. So yeah, it's an interesting journey to get there, but I'm glad I've made it here, to be perfectly honest.
Yeah, it's one of those professions, a bit like tax, where things are changing all the time. So it's never a static thing that you're doing the same thing day in, day out. There's always new products on the market. There's differences to the property market as a whole, and you've got to keep up in line with that. Also, new piece of legislation. So same for you as it is for me. Every day's a school day, and I try and learn something new every single day.
Yeah, I think especially at this time, because as difficult as it is as well, it's also a very interesting time in terms of a learning experience, because things are changing daily. I'm sure we'll talk about a lot of that in the next sort of half an hour or so. But the changes that are coming through thick and fast, and a lot of them are moving in the right direction. So hopefully we'll see that it's all part of the process of getting us back to pre-coronavirus levels.
Yeah, and there are, you'll see a few mortgage advisors around. Have you got a particular niche that you focus on, and sort of what sets you apart from others?
Yeah, I'm qualified to cover more or less all aspects of mortgage work, from standard purchases, remortgages, buy-to-let work, commercial mortgages if we need to. But realistically, over the last probably year to 18 months, I've transitioned into doing a lot more work with specialist lenders, so helping self-employed people, whether you're a sole trader in a partnership or a limited company director, making the most of what you earn in order to maximise affordability for people as well, that type of thing. And also dealing with specialist lenders in the adverse sector or non-high street sector, if that's what you want to call it. So people who may not have had the best or the squeakiest clean credit history previously. I do a lot of work with people like that because I don't think that people should necessarily be judged on a financial event that happened to them 4, 5 or 6 years ago, as our current system works. You know, I understand the history is important, but you know, I'm a firm believer in giving second chances, and that's why I think that sort of sector appeals to me quite a lot.
Yeah, definitely. And from my experience working with you, I know that I've got a couple of clients where a few mortgage advisors looked at it and just said, no, we can't do this straight away. I don't know that you've had a look, and I, you know, looking to close on some of those deals now. So it's you know, certainly that specialised sector, the distress sector, is something where a lot of people just turn it down straight away and don't think they're ever going to get what they're looking for. But that's where you would come in and point them in the right direction and get the right deal for them.
I think that goes hand in hand with planning as well, and thinking about what's going to happen in the future in terms of, okay, it's not necessarily something we can do now, but there are plenty of lenders out there now who, if you can show just 6 months in some cases of clean credit history, or certainly before coronavirus hit, 6 months worth of clean credit history, and they'd look at taking a mortgage application from you. And I think a lot of advisors wouldn't necessarily know that, because the amount of knowledge contained, or the amount of knowledge you need to know every single mortgage product, is huge. And it just so happens that I've, once again, quite fortunately, fallen into this niche market where I'm dealing with these lenders quite often. So I'm reasonably up to date on their criteria. And sometimes it is about sitting down with a client and saying, look, this may not happen right now. However, if you can look after, you know, these accounts that you've previously struggled with for the next 6 to 12 months, and keep up to date, you know, by checking your credit profile and things like that, and that's something I can potentially help you with in the future. And I don't think that advice is always given correctly in some cases. However, advice is always tailored to the individual as well. What I would like to stress is, even though I'll talk about lenders today and rates and things like that, everything I talk about is only opinion at this point, because without meeting a client on a face-to-face basis and carrying out a full fact find, I'm not in a position to advise anyone. Yeah,
absolutely. I know you mentioned coronavirus in what you were saying just now, and obviously this has had a massive impact on the mortgage market and the property market in general. Can you give us a sort of a brief overview of how it's been affected and what the response has been by lenders?
Yeah, I think you know, initially there was sort of this panic, really. We saw lenders withdrawing products, some lenders exiting the market. So in terms of the really big lenders, Halifax, Barclays withdrew all their products above 60% loan to value, but very quickly reintroduced them as well. We saw the specialist side, Precise and Bluestone, more or less stopped all incoming applications. But again, both of those are returned to the market. And I think what that tells me is lenders are quite resilient. There's a real resilience out there in terms of lenders still wanting to lend. There's still a really good appetite in terms of money available to mortgage borrowers. And then when you look at the reasons for product withdrawals, to me, it was pretty evident that what it came down to was, one, lenders didn't want to overexpose themselves, and two, as well, with lockdown coming in and physical valuations not being something that would be able to be carried out, lenders needed to move to new systems to carry out more automated valuations and desktop valuations. Some lenders simply weren't prepared for it, and I think that's potentially hit the specialist market a little bit more. But a lot of the high street lenders are back at 80 and 85% already, and rates are still low. We've seen rates reduced by a number of lenders because they are still pushing for that business all the way up to 85%. And I think in terms of what we're looking at in the future is this may actually be a good thing with the introduction of these technologies, because it'll certainly speed up mortgage applications. Prior to coronavirus, the only lender I know off the top of my head was probably HSBC, who were using automated valuations on a huge number of their applications at decision in principle stage, which is the very first stage of the mortgage application. So when you would do a decision in principle with HSBC, you would get an automated valuation at that point. And then if that automated valuation didn't line up with the client's valuation, at that point, HSBC would instruct a physical valuation if necessary. And what we're seeing now is a lot more lenders are using that system. And that's a good thing for consumers in the future, because it'll speed up the process in general.
Yeah. On the decision in principle thing you just said, I think maybe across the market, depending on the sort of industry you're in when you're looking for a mortgage, there might be a bit of a misunderstanding about what that actually means. So in the mortgage process of first applying for until completion and getting the funds through, yeah, what's the sort of an overview of the timeline and the different terms you might hear?
So that's a great question, really good question, because it fills in the gaps in terms of what people understand in terms of the mortgage process. So if I look just at the way I work, because I can't speak for every single advisor, because there's different ways of doing things. Now, we work primarily on a face-to-face basis, sorry. And that means I'll meet all my clients face-to-face. They get to know me, I can introduce myself properly, I can understand what they like, and I'm a firm believer that's the best way to do business. And even though face-to-face might now actually be through things like Zoom or FaceTime or WhatsApp, they're a very good substitute in one respect for actual face-to-face meetings. Nothing will be as good as a proper face-to-face meeting, but the technology we have now allows us to conduct business in a similar way to what we did previously. But the face-to-face meeting would then involve a fact find where we'd sit down and get to know the clients, not just on like a financial level, but it's important to understand them on a personal level as well, and understand their needs and wants, not just for now, but for the future, because there's an awful lot of planning that goes into this. It's easy to get someone a mortgage for now for a 2-year fix and then leave them to it. But actually, what do the clients want, not just in the next 2 years, but also in the next 5 and 10 years? What are their plans? So it's a lot about understanding that. When we have that information, then I'll input it into my system. The system will filter out most of the products that don't apply to the client, so it can be filtered by loan to value and loan size, and region, or if there's any adverse credit or anything like that, so to work out which lenders are the ones that need to be approached. And at that point, then when I've selected the lender from the sourcing that meets the client's needs best, and typically that starts with looking at the best rates and working down from there. Then we would start the decision in principle process, and that is approaching a lender directly for a decision on whether that lender is happy with the information we're supplying to them, and whether they're happy to lend to the client. That typically will involve a credit scoring or a credit check with most lenders. If you pass that, then it's on to the full application stage, where we'd request things like full pay slips and bank statements and things like that to understand the financial picture properly. We check them against the information provided at the first meeting, and then we'd submit a full application. Once that's in, it's down to the lender then to okay it. Service levels at the moment, so the time it takes a lender to look at a case from submission to actually offering, it isn't too bad. We're seeing some lenders that are around 5 or 10 days, which, given the volume of work they're having, and that a lot of people are working from home, and potentially staff are on furlough, that's not bad at all. Especially some of the bigger lenders are doing really well in that respect. From there, if everything gets okayed, we'll have a valuation conducted. As I mentioned earlier, HSBC do this at dip stage, so you're cutting out the step of the process further down the line in HSBC's case, which speeds things up, because you can instruct a valuation. Sometimes it could take a week or two for that valuation to get done. If the valuation comes back and it's all okay, then typically you get an offer, which comes out to us, to the clients, and to the solicitors involved if there are any. And then once the solicitors sign everything off, you're down towards the end of the transaction. On a remortgage, it simply releases money. If it's from one remortgage from one bank to another, then it goes through a solicitor. If you stay in with your current lender, then the money is released directly to you. And if it's a purchase, it's again handled by solicitors to fulfill the chain if there is one. So, the process from my point of view is always reasonably straightforward. But again, I understand why people have so many gaps about this, because I don't think people take the time to explain it properly in terms of what actually happens and the work that we actually do. Yeah.
The decision in principle, then, is that always based on a particular property, or is that something you can get an indicative, get a decision in principle before you actually decide on the property, which means when you decide on the property, you can go straight to the solicitor then.
Yeah, there's a little bit of a clash between sort of what the property market expects and the way mortgages have been done historically. So I think if you're in a chain and you've got a house to sell and you want to buy a new one, then typically you need to have accepted an offer on your current property in order to be in a position where the funds are almost being released in one respect, because once you accept the offer, then the process begins. And in order, once you've done that, then you're allowed to make an offer on the property you want to buy. Now, that would mean that you need a mortgage decision in principle at that point, because you need to be able to prove that you can buy that property. And I would say the mortgage decision in principle is basically the small. It's like a soft yes. Is probably the best way to describe it. It's based on the information provided, but you're happy to move to the next step for a full mortgage application. Banks these days are very, very good in terms of the information they require. They've got automated systems where they can check credit that people have got outstanding. So I think, historically people think they could run away or hide from some debt and things like that. That simply doesn't really happen these days. I think if you've got anything previously, especially in the sector that I deal with, the one thing I will say to clients is if you, especially in initial meetings, anything you've got on credit or finance or anything like that, if you've got a couple of £100 on a Next card or an Argos card, tell me about it, because the chances are the lender is going to know about it. And I think in that respect, it's a good system, and it's important that people understand that it is just the first step. The decision in principle is just the first step in the mortgage process. So in that respect, I think it's what people don't understand essentially is what it means. They need a decision in principle in order to make an offer on a property, and that's why you get a lot of estate agents encouraging people to come in and see their in-house mortgage brokers.
Yeah, thanks. I think that's really interesting to know, because there might be a disconnect between what actually happens and what the buyer or seller is thinking is actually happening. I suppose from your point of view is it's a service-led business, and your reputation is based upon the service you provide to the client. So it's all about communication lines, isn't it?
Yeah, absolutely. And it's easy to say, we're the best at what we do, and we've got this fantastic reputation, and I think Total Mortgage Network does, and we are very, very good at what we do in that respect. And yes, we are up there with the best. But yeah, you are providing a service at the end of the day, and there is that expectation from the clients. But it's important the clients understand what that service actually is. So the steps along that process. So I think it's important to explain that.
Yeah, definitely. I think that's important in a lot of service-led businesses like ours in the accountancy and tax industry as well. We talked about the impact on the market and lenders from COVID, but obviously with the government schemes available, so the business interruption loans and the bounce back loans, is that going to have an effect on somebody's profile when they look to put a mortgage application in?
I think there is no straightforward yes or no answer on this. So I've spoken to a number of lenders already, and some of them, or typically there's different ways of looking at it. So if you look at the bounce back loan specifically, I know that Nationwide and NatWest both now have additional documents that need to be completed along with the mortgage application for sole traders, partnerships, limited company directors. And on there will be an explanation or a question regarding any government support you've received. So what government support have you received? And then the impact of that on your business. So for example, with a bounce back loan, it's my understanding, and certainly with the ones that I've come across, when you apply for it, you were saying you've been adversely affected by coronavirus. So in that respect, the lender will want to understand what that adverse effect on your business is, and whether you will then continue to function normally, because some businesses will increase their bottom line profit year on year, and it may mean that for this year, what will happen is that profit will just flatten out for you, and then they'll get back to normal trading next year. And if that's the case, then typically most lenders are going to be happy with that, providing that information tallies up with what's on the client's personal SA302s or the information that comes through from the accountants. So that's the high street view. The specialist lender view is a little bit different. I know for a fact that Pepper Money, who are one of the specialist lenders that are still out there in the 80% loan to value market, are simply saying no to any application with a bounce back loan, which, you know, I do understand why, because again, you're stating your business has been adversely affected. When you've got people like Bluestone and Kensington and Aldermore, they all want to know what the impact is. So similar to the high street guys, they'll want to know what the impact is. They'll potentially ask you for accountants references and things like that. So that's when someone like yourself comes in, as to what the future of the business looks like, because typically that's what your mortgage is based on. It's based on what your income is now, but as long as you can prove that income going forward, then I think that's the way that most lenders are looking at it now.
Yeah, you mentioned SA302s there and accounting certificates.
Mm-hmm.
Now, in my line of work, I come across these quite a lot, because when clients want to get a mortgage, we predominantly look after, you know, directors of limited companies and partners and sole traders. So, you know, it's obviously not as simple as producing a P60 and some pay slips then, because the way they remunerate themselves is vastly different from an employed person.
Yeah.
I know that a few years ago, the Council of Mortgage Lenders sort of had an agreement with HMRC, and now that's become more standardised in terms of what the SA302 is. So if anyone doesn't understand what an SA302 is, it is a one-page tax calculation showing what was earned during the year and what your tax liability is if you complete the self-assessment. And often mortgage lenders want to see then the tax year overview, which is a printout from your government gateway, and they want to see that the tax figure on the overview matches the tax figure on the SA302. Now, I know in some cases that might not be enough, because it's a bit more of a complicated case. So what type of questions do they sometimes ask?
So that would come back to, and I know this is going to seem, it's quite easy to fulfill actually, because normally it's an accountant's reference. An accountant's reference would be a standard template. And it's quite an odd thing for them to do, because in the accountant's reference, they're simply asking for the same information that's provided on an SA302. However, they may ask for a projection of the current year as well. And that typically will be the only difference, because what they're doing, as I just mentioned, is looking for the future as well. I mean, no one really knows what things are going to be like in 5 or 10 years, but at least if the bank are comfortable with, you know, your profit being sustained, or your level of income is probably a better way of describing it, being sustained over at least the next year or so, which is the same for anyone, even in employment, then in that case, they're happy to lend. But you're spot on about the documents you mentioned there. SA302s, tax year overviews are typically what almost all lenders will ask for. In relation to that, there's a difference between, and there's a misconception as well, that some people think that in the first year of self-employment, they won't be able to apply for a mortgage. Well, typically that's not true, because you've got a high street lender out there, Halifax, who will allow you with just 1 year's trading, and providing you've got an SA302. It needs to be probably 1 year, full year, because you want to show that full amount. They'll allow you to apply for a mortgage with basically 1 year trading, with 1 year's SA302s and tax year overviews. And then in the specialist side, you've got Bluestone, Kensington, Pepper Money, all with 1 year trading. Aldermore will now want 2 year trading. Pre-coronavirus, they were looking at 1. They'll want 2 year trading, but they'll work out your affordability off the most recent year, which means for people who have just moved into self-employment and maybe had a slower first year, and then the business has taken off in the second year, that's fantastic, because they're looking at the growth in the business as well. So I think from that point of view, there's a lot of help and support out there, and as well, it's not as treacherous as people may think it is when they're self-employed to apply for normal high street mortgages as well. I think the standard for a high street mortgage would be 2 years SA302s and tax year overviews, and maybe an accountant's reference. And from that point on, then it's down to whatever the lender needs or wants from the clients, providing the clients can supply it.
Yeah, I think where you said there's a misconception there, I agree there. I often hear people say, oh, well, I can't get a mortgage. I need 3 years worth of self-employed accounts first. Or I need, 3 years worth of limited company accounts first. And obviously, like you said there, someone like Halifax is doing a 1 year. So When it comes to self-employed and directors, limited companies, because it's always more complicated, my advice to them is always, have a chat with a mortgage advisor before you go down the route of doing anything yourself. Yes, you'd end up paying a fee to the mortgage advisor, but that fee will probably pale in comparison to savings they can get you over the next 3 to 5 years. It's a short-term pain of getting that, paying the fee for the product, but often that payback period is pretty short, because you guys will know which products will work better and potentially get lower rates from as well.
Yeah, I think that goes hand in hand with the future planning as well, which again I've probably spoken about a bit already. But it's about getting to know the client and not just what they want now, because people can be focused very much on the short term, which sometimes it absolutely has to be, especially if you're dealing with a client potentially with some debt in the background needs to be cleared. Then you are looking at a shorter term solution for them. But you've got to keep in mind what the long term impact of that's going to be. And typically, one of the best things that a mortgage advisor can do with you is to help you reduce the term of your mortgage, because that's where the real saving is, over the whole term. Because if you're paying your mortgage, even a mortgage for £300 a month, if you're not 2 years off that, without the interest saving aside, that's 2 years where you're not going to fork out £3,500 essentially on your mortgage. So just being able to reduce the term is a fantastic tool available to anyone really when they apply, but certainly mortgage brokers will give you the best advice in how to do that and the best products available for them.
Yeah. Early on you mentioned some 85% loans are still available. I know that before lockdown and coronavirus hit, there were some lenders doing 90 and 95%. I know a lot of those were pulled initially, but are they coming back in, and where do you see them going in the next sort of couple of months?
Yeah, so my expectation and my hope is that we return close to what we were pre-coronavirus levels when lenders work out where the housing market is. So I think once the housing market settles, I don't want to speculate on where it's going to go, because actually it's still reasonably healthy at the moment. But once the mortgage market is settled, I think we'll see a lot of lenders going back into 90 and 95%, potentially 95% lending. Currently, as it stands, the main lender out there, 90% on remortgage and purchase, is HSBC. We've got 2-year deals available from 1.9%, 1.89%, which is brilliant. When you look at where we are at 90% on both purchase and remortgage, and 5 years from 2.26%, which is again a very, very good rate when you look at historical mortgage rates. They are rock bottom from my point of view. Then you've got Monmouth Building Society, who have been in and out, and alongside them you've got Accord and Virgin Money, who have also been in and out of the 90% mortgage market. The issue that we've got currently from a mortgage broker's point of view is that HSBC are only offering a limited amount of, we don't know if it's applications, we don't know if it's an actual borrowing figure, but if you want a HSBC deal and you're a mortgage broker trying to get that deal for a client, you need to be up and at your desk probably about 6:30, 7 o'clock in the morning, key in the mortgage into the system and trying to get approved, because typically by about 8 o'clock, either the amount of mortgages they can accept in one day or the money they've got available for that particular day is gone, and then they'll stop lending at that 90% level for the rest of the day. And that's not HSBC's fault. It's good that HSBC are offering 90% products. Actually, it's other lenders not being willing to throw their hat into the ring essentially at 90%. And once more lenders do open up at 90%, it'll be less pressure on HSBC, because they're struggling from a service level point of view at the moment.
Yeah,
I think, but certainly future wise, I think if we get through this, which I fully expect we will, and whether it's in 2 months or 6 months time when we return to some sort of normality then, or whatever the new normal may be, we will see these higher level loan to value products coming back. On the specialist lender side, we still have lenders out there who are offering 80% loan to value deals. So Kensington, currently across the bridge in England, will go up to 80% loan to value, and so will Pepper Money. And then you've got the rest of the specialist lenders, Bluestone and Aldermore, and the other ones there at 75. I think Aldermore still might have some 85% products as well, which is very high for a specialist lender, given the current climate. So they are still out there supporting clients, and from my point of view, that's only a good thing.
Yeah, that queue for HSBC in the morning, that's like the mortgage advisor's version of trying to get a Glastonbury ticket, is it?
It honestly is. You may have seen some of the pictures around there, but luckily I haven't had to do it. But not that I wouldn't, because I definitely would. But I've seen people pulling their hair out with 5 or 6 applications they're trying to place a 90% loan to value, because that's maybe where their niche is. They work on that high level loan to value. And they're trying to get 5 or 6 done, and maybe they're getting 1 done every 4 or 5 days. But obviously that's about communicating with your client, and if that's what the client needs, I think as long as you're communicating effectively and explaining to them what's happening, then I think most clients would understand what's going on at the moment. I think if I look at my own client bank, I've still got 2 mortgage applications in there, 95%, that was submitted prior to coronavirus, and for one reason or another, coronavirus hit, those high loan to value products got withdrawn, but lenders are still honouring them because they were in before. So again, from that point of view, that's fantastic support from lenders, because they could turn around and pull those products if they really wanted to. It's down to them. It's their money. They choose how to lend it, but they aren't. And I think that is a really good indication of where they would like to return to in the future as well. If even though I said I wasn't going to speculate on some things, I will speculate on that. Yeah,
you've got to have a crack of speculating sometimes. I find myself doing it all the time, and then I have to go, hang on, that's just my opinion. We talk about the sort of the process of buying the property, getting the lending. Once you do buy the property, then I suppose the next consideration you've got is looking at house insurance and maybe some protection insurance as well, to make sure that you continue to pay the mortgage if something does go wrong in your life.
Yeah, I think these things go hand in hand. So when you buy a new property, for example, you'll need your buildings insurance, and I don't really know anyone who's got buildings insurance without contents insurance. And I think you'd be absolutely astonished if you sat down and worked out how much value there is in your home in terms of the contents. I think if you sat down and looked at it, people would be well over 50, 75, even upwards of 100 grand's worth of possessions within your home, in terms of when you look at your home insurance. Along with that, you've got your buildings insurance, so your reinstatement value and things like that. The buildings insurance is absolutely necessary to complete on a mortgage. That's something we can always help you out with general insurance. And I think we use a system, a fantastic system through YouInsure, who don't ask the 6 million questions that you would historically. So they're not interested in what locks are on your doors or locks are on your windows or anything like that. You literally input the property details, and it'll pull from the land registry the details on that property. And as long as it matches in terms of bedrooms and particular size and things like that, then it'll use that to generate a quote for you. And a lot of the basic sections are included in it, which is fantastic. With personal protection, it's something I'm really passionate about, simply because I don't think, and I think this coronavirus will highlight that potentially a lot of people are underprotected as well, or have no protection at all. So it's really important that at the most basic level, you have some form of life cover that would allow people you potentially leave behind, or if we become terminally ill, to pay off the mortgage. And then, and I would say this is a minimum, you have some form of serious illness cover, because sadly, the truth is you are far more likely to be seriously ill during your lifetime than you are to pass potentially before the age, 70, 80, whatever that may be at the moment. But you are far more likely to pick up an illness. And if you look at things like cancer rates, 1 in 2 people, 1 in 3, which is horrific when you sit down and think about it. And that's why protection is so important. And even if it's in your small protection policy, that pays off your mortgage and gives you a small amount of serious illness cover or critical illness cover, or whatever you want to call that element, I think at least it gives you some form of peace of mind. You'll be stunned at the amount of people who will be happy to pay $7.99 a month to have Netflix, but won't pay a £5 for a life policy. And if that's one thing I could change about people, that's the thing I would. You've got people paying 90 quid a month on Sky, but they roll their eyes at £22 a month for a life insurance policy. And I think that's one thing that if I could change about people's perception, it would be that. I mean, a lender forces you to have insurance for a property, but doesn't require you to have insurance for yourself, which that doesn't balance up or sit correctly with me. So you know, and as you can probably tell, I am really passionate about it. I work very closely with Vitality, who I think are absolutely fantastic in terms of the work they do with insurance products. They're probably the only provider out there who gives back to clients, and whether it's cinema tickets or coffees or money off sports equipment and things like that. They're genuinely brilliant in what they do. So, you know, protection is really important.
Yeah, it's one of those funny things about human nature, isn't it? A lot of it is sort of looking at the short term. I mean, if you pay 90 quid for Sky, you're getting the tangible benefits of it when you're sitting down and watching the TV or watching the sport when it comes back on.
Yeah.
But you're not seeing the tangible benefits of that payment that you're making to your life insurance until you absolutely need it.
And you as the policyholder, you might never see the benefit of that.
Yeah.
It's for people potentially you're leaving behind, which is can be a difficult conversation to have with people because they don't think about it that way. But that's exactly what it is. It's there to protect not just yourself, but the people you may leave behind if that does happen as well.
Yeah, and I think it shows as well that how much the rules and regulations and laws that are set by you know, government and local authorities or whatever country you're in really actually shapes your life. Because if you look at insurance, for example, like how much everyone has to have car insurance, so they pay for it, and the amount they pay for it is, you know, can be quite substantial. It can be a big chunk of cash each year. But then, you know, you insure your car, which is a machine that you use to get you places, but then you don't insure yourself, which is it's one of those peculiar sort of human psychology things and how we are shaped by actually the laws. And going off on a...
Yeah, completely agree with you, mate. Completely agree with you in that respect, Jane. It's, you know, and it is about maybe there's a little bit of misconception about life insurance previously where people haven't been paid and, you know, they should have. And I think that now comes down to, again, in the fact find, and there's a medical questionnaire that needs to be answered by clients to apply for life insurance. But they need to be honest about their health situation as well. And most people are, 99% of people are. But if you're going to make an application for anything and think that you can, you know, brush something under the carpet or hide something, then what's the point in doing it?
Yeah.
And I think that's where historically a lot of the issues have been with, you know, some life insurance companies not being willing to pay out. But I think Vitality, who I work with, are at something like a 99% payout level, which, you know, it's higher than that. But it's certainly, you know, one of the best out there.
Yeah. Going off on a slight tangent, this is where my inner nerd comes out, to show how different policies can affect the way people live, and it's from a tax perspective. So a long time ago, a new tax was brought in, which was going to tax people on the number of windows that they had on their property, and that was easier than the tax that was before that was on fireplaces, but that meant the tax man actually had to enter the property. So when this was introduced, this shows how, you know, how taxes can actually shape society in a massive way, which you don't really realize. People started then, when new houses were being built, they were being built with the option to have you could have a bricked up window, but it was an easy release to put an actual window in there. So that's why if you look around, you will see lots of properties where they've got sort of bricked up windows, which would be easily turned into actual windows. And that's why you see a lot of these older properties, which can be get quite damp and dark because of how little windows they've got in them. And yeah, that sort of shows the way in which people will, you know, change their behaviours for taxes. And the other strange one is some barking in a minute. I got the dogs in here. Right. Let me pause that a sec, right? And another little funny story about how taxes shape people's lives. I won't get this 100% correct because I read this a while back, so it's not it won't be 100%. But there was a point at which men used to wear their hair long and they'd wear the wigs. And one of the reasons why men started wearing their hair short was because a tax got imposed on wig powder. So because people didn't want to pay the tax on wig powder, they started, not wearing them because they didn't know what the powder may have been an integral part of actually wearing the wig. And they started cutting their hair short, and that's sort of the reason why men in the UK have historically cut their hair short.
I'm sure there's a hair joke somewhere in there, mate. But
yeah, absolutely. And I wouldn't have had the option anyway, so it would have been made for me.
How shiny I'm looking.
Yeah, I think if you gave me half of your hair, you'd still have more than me.
You're welcome to it, mate. I think, especially it's current lockdown haircuts, very stressful. Getting my wife to cut my hair, it's definitely interesting.
I think we've been at this for a while now, so I think if we just we finish this up, I got one sort of last question is, and you're gonna have to get a crystal ball up for this one, is where do you envisage the sort of property market along with the lending market moving in the next, say, 5 to 10 years?
This is, and you've trumped me a little bit there by mentioning a crystal ball. I often get asked this, and the truth is I don't have a crystal ball, because if I did, I'd be a lottery winner. I'm probably not a mortgage advisor. But the truth is nobody really knows. And I think if you look at events like coronavirus, it more or less came from anywhere. There was government planning about pandemics and things like that. But realistically, did anyone expect it to happen? And the answer is probably no to that, especially in the way that it developed and how quickly it spread, and the whole world changes within 6 months, essentially. So you can plan as much for the future as you want, but you've got to take that plan in with on the caveat that things aren't certain. Nothing is set in stone. I think one of my colleagues, I had a chat with one of my colleagues, and he described it best. I think if you look at lenders' longer term rates, so 7, 10, even 15-year fixed rates out there at the moment, they're really low. So HSBC, Nationwide, Accord, all around the 2.5%, 3% on 10-year fixed deals, which go back 5 or 6 or 7 or 8 years ago, you might not get that on a 2 or a 5-year fixed. So if you look at that, I think what from a lender's point of view, that's telling us that they expect rates to remain low for the foreseeable future, even with the current situation we're in, because all those lenders I just mentioned, they were lending this morning at those rates, again between 2.5% and just over 3%. And Virgin, for example, even have a 15-year rate out there, 15-year fixed rate at around the 3% mark, which is incredible when you think about it. And again, that tells me that the future from the lender's perspective is that rates are going to remain reasonably low. I'm not saying they'll be as low as they are now, because we are lower than we've ever been in one respect, if you look at the data for probably the last 2-3 years. But we'll expect them to remain reasonably low for the foreseeable future. But I can't emphasize enough the importance of fixing in for a period that suits you, whether that is 2, 5, 7, 10, or even 15 years. It's about what you want from that particular mortgage product, not just now, but in the future as well. Do you want the flexibility to be able to borrow more, which most lenders will offer you within a fixed rate, but at a higher rate than your current borrowing? Are you looking to move? Are you looking to borrow substantially more? Are you looking to pay off your mortgage in the next couple of years? If that's the case, then you probably err on the side of caution and take a 2 or a 5-year deal. If you have no more borrowing needs, if you're not planning on moving, although you can port almost all mortgages these days, and if you envisage that you plan on keeping your mortgage exactly as it is for the next 15 years, then by all means, talk to me about a 10 or a 15-year product. I still think that where we are at the moment, 2 and 5 years are probably the best fit for most people, because it gives you a short-term certainty with a little bit of flexibility. But certainly for the future, looking at it from a lender's perspective, with those very long-term deals still there, that tells me that they're not expecting any huge or substantial shift in interest rates.
All right. So yeah, thanks for joining us today, Ceri.
Really good.
If you want to, do you want to give your email address quickly?
Yeah, my email address is kerry.evans@tmnadvisor.co.uk. You're more than welcome to get in touch with me if you've got any questions or anything like that. I think Jamie will put in the description as well, just to help people out. And again, I'm happy to help people out in any way, even if it's just answering some pretty straightforward questions you may have, because you never know what happens in the future. You may come back to me to do some business in the future. So yeah, I'm happy to help anyone in that respect.
Yeah, I'll put the email address in the description of the video, and right about now you'll be seeing some button somewhere on the screen to subscribe to our channel. So if you want to get some notifications when we upload some new videos, hopefully on a weekly basis from now on, click the subscribe button and you'll get notified of that. Thanks, Ceri. See you again.
Great. Thanks, Jamie. Thanks very much.